commodity prices remain elevated. Countries across the world are facing inflation at decadal highs and persistent demand-supply imbalances. The war has led to globalization of inflation. Not surprisingly, central banks are reorienting and recalibrating their monetary policies. Emerging market economies are facing bigger challenges from the increased market turbulence, monetary policy shifts in advanced economies, and their spillovers. The process of economic recovery in the EMEs is also getting affected. During these difficult and challenging times, the Indian economy has remained resilient, supported by strong macroeconomic fundamentals and buffers. The recovery has gained momentum despite the pandemic and the war. On the other hand, inflation has steeply increased much beyond the upper tolerance level. A large part of the rise in inflation is primarily attributed to a series of supply shocks which can be linked to the war. In these circumstances, we have started a gradual and orderly withdrawal of extraordinary accommodation instituted during the pandemic, that is the COVID-19 pandemic. Similar to our resolute and timely actions to limit the economic damage emanating from the COVID-19 pandemic, the Reserve Bank will continue to be proactive and decisive in mitigating the fallout of the ongoing geopolitical crisis on our economy. We have already reprioritized our policies to control inflation without losing sight of the growth requirements. Our approach underscores a commitment to move towards normal monetary conditions in a calibrated manner, and our steps will be measured. We will remain focused on bringing down inflation closer to the target and fostering macroeconomic stability. Let me now focus on the decisions and deliberations of the Monetary Policy Committee meetings, the meeting which we had recently. Against this background, the Monetary Policy Committee, that is MPC, met on 6th, 7th, and 8th of June, and based on an assessment of the macroeconomic situation and the outlook, the MPC voted unanimously to increase the policy repo rate by 50 basis points to 4.90% with immediate effect. Consequently, the standing deposit facility, that is the SDF rate, stands adjusted to 4.65%, and the marginal standing facility, that is the MSF rate and bank rate, to 5.15%. The MPC also decided unanimously to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. Let me now explain the MPC's rationale for its decisions on the policy rate and the stance. The protracted war in Europe and the accompanying sanctions have kept global commodity prices elevated, and this is across the board. This is exerting sustained upward pressure on consumer price inflation well beyond the targets in most of the economies. The ongoing war is also turning out to be a dampener for global trade and growth. The faster pace of monetary policy normalization undertaken by systemic advanced economies, that is AEs, is leading to heightened volatility in global financial markets. This is reflected in sharp corrections in major equity markets, sizable swings in sovereign bond yields, US dollar appreciations, capital outflows from EMEs, and even from some advanced economies. The EMEs are also witnessing depreciation of their currencies. Global stagflation concerns are growing and are amplifying the volatility in global financial markets. This is feeding back into the real economy and further clouding the overall outlook. The MPC noted that in such challenging global environment, domestic economic activity is gaining traction, while inflation pressures have intensified further. The upside risks to inflation, as highlighted in the April and May 2022 policies of the MPC, have materialized earlier than anticipated, both in terms of timing and magnitude. Inflationary pressures have become broad-based and remain largely driven by adverse supply shocks. There are growing signs of a higher pass-through of input costs to selling prices. The MPC noted that inflation is likely to remain above the upper tolerance band of 6% through the first 3 quarters of the current financial year, that is 22-23. In this context, supply-side measures taken by the government in reducing excise duties on petrol and diesel, along with other measures, would help in mitigating the inflationary pressures to some extent. The MPC also recognized that sustained high inflation could unhinge inflation expectations and trigger second-round effects. The MPC therefore judged that further monetary policy measures are necessary to anchor the inflation expectations. Accordingly, the MPC decided to increase the policy repo rate by 50 basis points to 4.9%. The MPC also decided to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. It may be noted in this context that the repo rate still remains below its pre-pandemic level. I would now like to provide an assessment, a more detailed assessment of growth and inflation. And first, I would like to take up growth. According to the provisional estimates released by the National Statistical Office, that is NSO, on May 31st, India's gross domestic product, that is GDP growth, in 21-22 is estimated at 8.7%. This level of real GDP in 21-22 has exceeded the pre-pandemic, that is the 2019-20 level. On the supply side, major categories also surpassed the 2019-20 level. Available information for April and May indicates that the recovery in domestic economic activity remains firm, with growth impulses getting increasingly broad-based. Manufacturing and services purchasing managers indices, that is the PMI, for May point towards further expansion of activity. This is also corroborated by movements in railway freight and port traffic, domestic air traffic, GST collections, steel consumption, cement production, and bank credit. While urban demand is recovering, rural demand is gradually improving. The contact-intensive services related to trade, hotels, and transport have recovered in Q4 of 21-22. Going by the early results of our surveys, capacity utilization in the manufacturing sector increased further to 74.5% in the fourth quarter of 21-22 from 72.4% in Q3 of 21-22. So that is in the last financial year, 21-22, between Q3 and Q4, the capacity utilization in the manufacturing sector increased from 72.4 to 74.5%. Capacity utilization is also likely to increase further in the current financial year. Investment activity is thus expected to strengthen, driven by rising capacity utilization, government's capital expenditure, and deleveraged corporate balance sheets. Improvement in investment activity is also reflected in pickup in demand for bank credit and persisting growth in imports of capital goods. Merchandise exports have remained buoyant with double-digit growth for the 15th successive month in May this year, while high growth of non-oil, non-gold imports is indicative of recovery in domestic demand conditions. Looking ahead, real GDP is expected to broadly evolve on the lines of the April MPC resolution. The forecast of normal southwest monsoon should boost Kharif sowing and agricultural output. This will support rural consumption. The rebound in contact-intensive services is expected to sustain urban consumption. Our surveys suggest further improvement in consumer confidence and households' optimism for the outlook a year ahead. Business sentiment remains upbeat according to early results of our surveys. Nevertheless, the negative spillovers from geopolitical tensions, elevated international commodity prices, rising input costs, tightening of global financial conditions, and slowdown in world economy continue to weigh on the outlook. Taking all these factors into consideration, the real GDP growth for 2022-23, that is for the current year, is retained at 7.2%, with Q1 at 16.2%, Q2 at 6.2%, Q3 at 4.1%, and Q4 at 4%, with risks broadly balanced. I would now like to focus a little more on inflation. The CPI headline inflation in April registered a further sharp increase to 7.8%. It was the fourth consecutive month when inflation touched or was above the upper tolerance level of 6%. The surge in headline inflation was seen across all major categories. The global geopolitical situation remains fluid and commodity markets remain on the edge, rendering heightened uncertainty to domestic inflation outlook. Certain positive developments on the prices front in recent weeks may help to ease the acute price pressures to some extent. These would include expectations of a normal southwest monsoon and Kharif agricultural season, the recent supply-side measures taken by the government and the unfolding of their impact, lifting of palm oil export ban by a major supplying country, that is Indonesia, and signs of moderation in global industrial metal price indices. Our quick survey of urban households undertaken after the excise duty cuts of petrol and diesel on May 21st shows a significant moderation in inflation expectations of the urban households. And we notice declines of 190 basis points in their 3-month ahead expectations and 90 basis points in their 1-year ahead expectations. In such a scenario, further reduction of state VATs on petrol and diesel across the country can certainly contribute to softening the inflationary pressures as well as the inflationary expectations. Notwithstanding these positive developments, upside risks to inflation do persist. These risks emanate from elevated commodity prices, revisions in electricity tariffs across many states, high domestic poultry and animal feed costs, continuing trade and supply chain bottlenecks, rising pass-through of input costs to selling prices in the manufacturing and services sectors, the recent spike in tomato prices which are adding to fuel inflation, and most important of all, the elevated international crude prices. With assumption of a normal monsoon in 2022 and average crude oil price in the Indian basket of $105 per barrel, inflation is now projected at 6.7% in 2022-23, that is the current year, with Q1 at 7.5%, Q2 at 7.4%, Q3 at 6.2%, and Q4 at 5.8%, with risks evenly balanced. It may be noted that around 75% of the increase in inflation projections can be attributed to the food group. Further, the baseline inflation projection that we are making now at 6 and 7% for the current year, it does not take into account the impact of monetary policy actions taken today. Between February and April, headline inflation has increased by about 170 basis points. With no resolution of the war in sight and the upside risks to inflation, prudent monetary policy measures would ensure that second round effects of supply side shocks on the economy are contained and long-term inflation expectations remain firmly anchored and inflation gradually aligns closer to the target, or rather close to the target. The monetary policy actions, including withdrawal of accommodation, will be calibrated, keeping in mind the requirements of the ongoing economic recovery. I would now like to touch upon the liquidity and financial market conditions. It may be recalled that in April, we introduced the Standing Deposit Facility, that is the SDF, as the floor of the liquidity adjustment facility, that is the LAF corridor, at an interest rate of 3.75%. This was effectively a rate hike of 40 basis points over the fixed rate reverse repo of 3.35%. As a result, the weighted average call money rate, that is the WACR, which is the operating target of monetary policy, moved from an average of 3.32% in March 2022 to 3.54% during April 8th to 30th. Following the repo rate hike of 40 basis points on May 4th, the WACR, that is the weighted average call money rate, has further increased, averaging 4.07% during May 5th to 31st. I'm taking May 5th because there was a rate hike on May 4th, as you would recall. In line with the emphasis on gradual withdrawal of accommodation articulated in the MPC resolutions of April and May, systemic liquidity has moderated in the recent period. Surplus liquidity, as reflected in average daily absorption under the liquidity adjustment facility, that is the absorption under SDF and the variable rate reverse repo auctions of 14 days and 28 days at 5.5 lakh crore. In other words, what I'm saying is that the surplus liquidity as reflected in the daily absorption under the LAF at 5.5 lakh crore during May 4th to 31st was lower than 7.4 lakh crore during April 8th to May 3rd. Nevertheless, the overhang of excess liquidity has resulted in overnight money market rates on an average trading below the policy repo rate. At the longer end of the money market term structure, interest rate on 91-day treasury bills, commercial papers, and certificates of deposits have firmed up post the rate hike in May. Yields on AAA rated 5-year corporate bonds have also increased. The rate hike also led to an upward adjustment in the benchmark lending rates by the banks. The term deposit rates of banks have also increased, and this will augment stable funding resources amidst increasing credit demand. Going ahead, while normalizing the pandemic-related extraordinary liquidity accommodation over a multi-year time frame, the Reserve Bank will ensure availability of adequate liquidity to meet the productive requirements of the economy. The Reserve Bank will also remain focused on orderly completion of the government's market borrowing program. I have not listed out in my statement what steps we will take to ensure orderly implementation of the government's borrowing program. That is because we are monitoring the GSEC market very closely, and necessary steps would be taken by the RBI as and when required, as per the evolving scenario. A direct fallout of the geopolitical tensions and the rapid pace of monetary policy normalization by advanced economies is the exodus of portfolio capital flows from most EMEs. Several EME currencies have thus faced depreciation pressures. Safe haven demand for US dollar has increased amidst all this. The Indian rupee has moved in an orderly fashion and has depreciated by 2.5% against the US dollar during the current financial year so far, that is till yesterday. Now this has fared much better than many of the EME peers. In other words, the performance, the Indian rupee has actually perform much better than the other EMEs and the many of the EME peers. Amidst all this, the Indian banking system remains strong and its health has improved in recent years as reflected in key indicators: capital adequacy, asset quality, provisioning coverage, and profitability. Bank credit offtake has gradually improved in recent months, supported by both resilience of the banking system and progressive normalization of economic activity. The strength of the banking sector and deleveraged corporate balance sheets will help us in sustaining economic recovery. I would now like to touch upon the external sector. India's exports have performed exceptionally well despite weakening recovery across major trading partners. The impact of rising crude oil prices on petroleum, oil and lubricants, that is the POL import bill, has been partly offset by export of petroleum products, which also benefited from better price realizations in the recent months. Optimism on exports of both goods and services and remittances should help contain the current account deficit at sustainable level, which can be financed by normal capital flows. As on 3rd June this year, that is as on 3rd June, India's foreign exchange reserves were of the order of $601.1 billion US, which are further supplemented by a healthy level of net forward assets of the RBI. Now, before I proceed to announcing certain additional measures, let me just say that the situation overall is challenging, but as we have dealt with the difficult situation that we were confronted with during the pandemic, we are committed and determined and resolute in dealing with the current challenge to the Indian economy, most of which are emanating from external factors. So that is a point which I would like to make emphatically. I shall now announce certain additional measures, the details of which are set out in the Statement of Developmental and Regulatory Policies, which form Part B of the MPC statement, and this will be uploaded in the RBI website soon after my statement is over. And the additional measures are important, and they are as follows. The first set of announcements relate to regulatory measures in respect of cooperative banks. Considering the importance of cooperative banks in promoting inclusive growth, 3 measures are being announced for the cooperative banking sector. 1, the limits for individual housing loans being extended by urban cooperative banks and rural cooperative banks, which are basically state cooperative banks and district central cooperative banks, which were last fixed in 2011 and 2009 respectively, are being revised upwards by over 100%, taking into account the increase in house prices. This will facilitate better flow of credit to the housing sector. The second point relating to UCBs, the cooperative banking sector, the second announcement is that in line with the dispensation available to scheduled commercial banks and urban cooperative banks, it is now proposed to permit rural cooperative banks, and they consist of, as I mentioned, state cooperative banks and district central cooperative banks, to extend finance. So we are permitting the rural cooperative banks to extend finance to commercial real estate, that is residential housing. And this will be basically loans for residential housing projects within the existing aggregate housing finance limit of 5% of their total assets. This measure will further augment credit flows from the cooperative banks to the housing sector. The third measure in respect of cooperative banks is that we have decided to permit urban cooperative banks to extend doorstep banking services to their customers. This will enable the urban cooperative banks to meet the needs of their customers, especially the senior citizens and the differently abled. The next announcement relates to margin requirements for non-centrally cleared derivatives. Basically, I am referring to the OTC bilateral derivatives. With the objective of strengthening the resilience of OTC derivative market and in line with the G20 reforms, the Reserve Bank is putting in place margin requirements for non-centrally cleared OTC derivatives. Let me repeat. With the objective of strengthening the resilience of OTC derivative market and in line with the G20 reforms, the Reserve Bank is putting in place margin requirements for non-centrally cleared OTC derivatives. In the first phase, directions on exchange of variation margin for these non-centrally cleared derivatives were issued on 1st of June after consultation with the stakeholders. In the second phase, it is now proposed to mandate the requirements of the exchange rate. In the second phase, it is now proposed to mandate the requirements for exchange of initial margin for such derivatives. To garner feedback from stakeholders on these requirements, draft directions on exchange of initial margin for these derivatives will be issued shortly. The next announcement is important. It relates to e-mandate on cards for recurring payments, enhancement of the limit. The framework for processing of e-mandate based recurring payments was introduced by the Reserve Bank, keeping in mind the benefits of convenience, safety, and security to the users. Under this framework, over 6.25 crore mandates have been registered in favor of large number of domestic and over 3,400 international merchants. To further facilitate recurring payments like subscriptions, insurance premia, education fees of larger value under the framework, the limit is being enhanced from rupees 5,000 to rupees 15,000 per transaction. This will further leverage the benefits available under the framework and augment customer convenience. The next announcement relates to UPI, that is Unified Payment Interface, and their linking of the UPI to RuPay credit cards. UPI has become the most inclusive mode of payment in India with over 26 crore unique users and 5 crore merchants on the platform. The progress of UPI, in fact, in the recent years has been unparalleled, and its overall functioning has been quite exemplary, and now many other countries are engaged with us in adopting similar modes and similar methods in their countries. In May this year alone, about 594 crore transactions amounting to rupees 10.4 lakh crore were processed through the UPI. At present, UPI facilitates transactions by linking savings or current accounts through users' debit cards. It is now proposed to allow linking of credit cards on the UPI platform. To begin with, the RuPay credit cards will be linked to the UPI platform. This will provide additional convenience to the users and enhance the scope of digital payments. And finally, the final announcement relates to review of Payment Infrastructure Development Fund scheme, that is the PIDF scheme. We had launched a fund if you remember last year, to sort of proliferate and to spread the payment infrastructure, the digital payment infrastructure across the country, and this relates to that. The Payment Infrastructure Development Fund, that is the PIDF scheme, was operationalized by the Reserve Bank in January 2021 to incentivize the deployment of payment acceptance infrastructure such as physical point of sale, that is POS machines, mobile POS machines, quick response codes, that is QR codes, in tier 3 to tier 3 centers and in the northeastern states. Beneficiaries of the PM Swanidhi scheme in tier 1 and 2 centers were included in this scheme in August 2021. As at the end of April this year, over 1.18 crore new touch points have been deployed under the scheme against a target of 90 lakh touch points to be deployed over 3 years, that is till end of 2023. In fact, we had kept the targets a bit conservative because in the beginning we did not want to overcome it. But now I am happy to report that in just about 1.5 years, we have exceeded the target which was set for ourselves and for the banks for the next 3 years. So it is therefore proposed to make certain modifications to the PIDF scheme by enhancing the subsidy amount, simplifying the subsidy claim process, and by other steps. This will further accelerate and augment the deployment of payment infrastructure in the targeted geographies. I would now like to conclude my remarks for today. Experience teaches us that preserving price stability is the best guarantee to ensure lasting growth and prosperity. Our actions today will impart further credibility to our medium-term inflation target, which is the central tenet of a flexible inflation targeting framework. India's recovery is proceeding apace, offering us space for an orderly policy shift. While we will continuously assess the evolving situation to tailor our responses, our actions must demonstrate the commitment to keep inflation and inflationary expectations under check. Therefore, monitoring and assessing inflation pressures and balancing risks to growth, I repeat, monitoring and assessing inflation pressures and balancing risks to growth will be crucial for judging the appropriate policy path as we move ahead. The road we have traveled during the recent past has indeed been very arduous, but we gathered faith, focus, and fortitude along the way. Our actions today are in continuation of the several measures that have been taken recently to achieve price stability. Given the elevated uncertainties of the current period, we have remained dynamic and pragmatic rather than being bound by stereotypes and conventions. As the Reserve Bank works tirelessly in its pursuit of maintaining macro-financial stability, I am reminded of what Mahatma Gandhi said long time ago. If we want to overtake the storm that is about to burst, we must make boldest effort to sail full steam ahead. Thank you. Stay safe. Stay well. Namaskar.